Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Some of the stories now that we're tracking for you in the BNN Bloomberg newsroom. The Canadian economy added more jobs, but less than expected last month, failing to offset recent losses. Data from StatsCan showing the labor market added 14,100 jobs in March, missing economists' estimates of 15,000. Despite the loss, the gains marked the first increase in jobs for the year, driven by services and natural resources. Meanwhile, the unemployment rate held steady at 6.7%. We got some more insight on the numbers from a senior economist.
You got to take all of these numbers together. And what they highlight is, I think, a fairly stable labor market over the past year. The 6.7% unemployment rate is pretty close to what it was a year ago. This is not a job seekers market. There's all the challenges that have built up for Canadian workers looking for new jobs, looking to get into the labor market, youth unemployment. These all persist. But momentum-wise, it looks like things held steady.
Shares of Cascade are down after it lowered its first quarter earnings outlook by more than $10 million. The Quebec-based paper and packaging company says the revision reflects weather disruptions in the U.S., higher transportation and fuel costs, and ongoing geopolitical uncertainty. However, Cascade says it remains committed to its long-term goal of delivering $100 million in improved profit by the end of the year. Shares of Cogeco Communications are in the red, down 5.85%. This after the company posted revenue and profit in its latest quarter that missed estimates. Sales in its American telecom unit also came in below expectations. The company also cut its full-year revenue and profit forecast and warns that sales will be lower than expected due to higher pressure on its U.S. internet subscriber revenue. And a quick peek at the markets right now, and all the indices in the green, from materials down to consumer staples. Everybody in the green. Materials leading the way, up almost by 2%. And overall, the TSX up by 0.58%, continuing the rally that started last week. And it's up again almost to what it was pre-war in Iran. South of the border, similar situation. The rally there continuing as well, although it's softened a little bit. Actually, the Dow just took a turn. Last time I looked, it was in the green now. As you can see, it's dropped down into the red, off by 0.3. The S&P 500 up by 0.16, and the NASDAQ by 0.7. Shares of MTY Foods are under pressure after the owner of Cold Stone Creamery and Mr. Sub missed revenue estimates. The miss was driven by a decline in American corporate store sales. Joining us now is Colin White, CEO of Verican Capital Management, to talk more about this. Colin, thanks very much for joining us.
Oh, no worries at all. Glad to be here.
All right, we've got a few we're going to talk about right now. Let's just talk a big picture for the markets. Your thoughts on what's kind of unfolding right now?
Well, I don't know if I'm reading the tea leaves. I think there's some optimism building that the weekend is going to be a peaceful weekend where some things are going to get sorted out. So I think everybody seemed to be treading water with a little bit of optimism and hoping that cooler heads are in the process of prevailing. But optimism is a wonderful thing. But it's going to be, I think a lot's going to ride on this weekend. And I think right now the optimism is fairly high. We'll see how the afternoon plays out.
And is the market building that in, or could we see if there is more positive news coming out this weekend? Could we see the markets go even higher after this?
Oh no, absolutely. I think that the cliff is a little bit further away, right? But we're still looking for some assurance. As long as oil is staying up at the $100 a barrel or greater, market's a bit below right now, that's a problem. And we saw that coming out with the U.S. inflation numbers hitting 3.3%, largely driven by fuel prices. So, the status quo isn't comfortable. So we are going to need to see some improvements over the weekend to reverse some of what we're going through now. We're still hopeful, and there's still room to run from here. As you pointed out, the TSX almost back to where it was. So there's still a little bit of discount being put into the markets right now.
And with oil, we're hearing talk that if everything does end up being resolved, which is what we're all hoping for, we're still not going to see oil prices back to where they were prior, down in the 60s, even low 60s, even the end of last year, down in the 50s. Is that a problem, or is that something manageable?
Well, we're going to have to manage it. We don't have a choice. It's, you got a 900-pound gorilla in the basement. You just have to learn to deal with it. It's going to be there. I think that what we miss is how fragile these systems are. When you disrupt them in a meaningful way like you have, it's not like you just turn the tap back on and things go back to normal. Currently, there are companies that are working on workarounds and the effectiveness of those workarounds and getting supply to market, and for the market participants to provide different or find different suppliers. That's all active, but I do think it's very reasonable to expect we're not going to just fall back to $60 oil anytime soon. But if we can get more reliable, then maybe we can build ourselves back more towards that. But some of the jobs numbers that are coming out, and again, we look more at the economic indicators, as you referenced in the pre-show there. Canadian numbers being a little bit positive is nice, but we had two pretty bad months leading into that. And I think the job market is absolutely something that you want to keep an eye on. More people making more money, spending more money, that's good for the economy. Fewer people working, that's bad. And I think that that's a more fundamental driver to things in a more long term. And that's a malaise I think that we need to see reverse. One positive jobs number doesn't undo the $109,000 or 109,000 jobs that were lost in the first 2 months of the year. We have the continued threats and effects from the tariffs. You've got the public service sector that's in a little bit of a decline right now. And, you have immigration issues that are affecting participation in the workforce as well. So that's more important to watch. Seeing some positive jobs numbers come out over the next couple of months would be very comfortable to see and indicate that we can keep an economic growth pattern underway.
Okay, let's talk about a couple of companies. MTY coming out today. Profit rises, sales fall, though. Where your thoughts on that?
Well, the profit seems to have come from more of a currency play, which, again, is not a reliable thing. What I thought was more interesting in that report that came out is that we see these consumer sentiment things that get measured, and there's different versions of it. But when you see a company like this reporting a decrease in sales, I think that's more of a concrete example of evidence that the consumer sentiment is weak right now. So it was interesting to see that confirm something that we're seeing that's being measured on the macroeconomic side. Again, when you have a one-time gain off of FX, that's not something that you really want to build too closely into your model, because that can go the other way in a hurry. But again, the comments regarding decreased foot traffic and revenue being down is another indicator that's in line with some of the economic indicators. And you start to see a pattern. That's what we look for. Even when you're looking at an individual company like that, you want to look for something that's, okay, how does that fit into the overall sandbox that we're playing in right now?
And is it even more worrisome that it's a restaurant like Mr. Sub, which is something we can most consider affordable?
Yeah, absolutely. Because again, that's a very, very broad indicator. I'm a fan of having the odd sub. I like Mr. Sub, and I think a lot of people do. And I think in aggregate, if we're eating fewer subs, yeah, we're feeling some pain. Again, I think if you take a look at the price of some of this, and again, we measure these things on a macro level, but they're experienced on a very individual level. Higher fuel prices are affecting some people very, very directly. Other people's not so much. But again, you start measuring in aggregate, and I have to skip a sub this week because things are tight. Yeah, that's a real indicator that we're seeing some tightness in the economy. And I think that's way more important to pay attention to than some of the global tension that we're looking at right now.
All right, I want to jump to Chorus in case we run out of time. They're in a rough spot. Does it look like things are improving with these numbers you're seeing?
Well, the numbers can be what you need them to be. It's nice to see. I think they reported some positive cash flow, which was nice. They seem to have stopped the bleeding a little bit, but they're still bleeding, and they still have a turnaround story. And whenever I see, courts mentioned in their earnings report, I think they're doing some court-approved, some recapitalization. That's a worrisome from an investment perspective for sure. I wish them all the luck, but they are going through a titanic turnaround, and there's a lot of headwinds that they have to overcome to get somewhere. And I think that's what's reflected in the share price for sure. So nice to see some numbers, modestly positive cash numbers, but they still don't have something that's viable yet. They're going to have to keep plugging away.
All right, we got to wrap it up there, Colin, but thanks very much for joining us.
No worries. Have a great day.
Cheers, you too. Colin White, CEO of Verican Capital Management. Up next, we'll get an in-depth analysis of the latest U.S. CPI data. That's after the break. U.S. inflation jumped in March, driven mostly by a surge in energy prices and pushing year-over-year inflation back up to around 3%. It's raising questions about the Fed's path forward and the staying power of the disinflation trend. For more in-depth analysis, we're joined by Thomas Simons, chief U.S. economist at Jefferies. Thomas, thanks very much for joining us.
Thank you.
What do we do with these numbers and considering everything else that's around it?
Yeah, great question. I mean, looking at these numbers just in a vacuum doesn't really tell you a whole lot about what, we're going to be looking for on the path forward. We all know that gasoline prices went up quite a lot. Diesel prices went up even more. And when you think about, sort of what we see in terms of prices that are posted at the pump versus what the actual increases were in the data, it feels like there's probably even more of this to come in terms of realizing those price increases in the overall inflation data. So probably going to continue to see the headline inflation numbers be quite firm in April. We also saw virtually no food inflation in March, which I think is kind of contrasting with most people's experiences as well. And considering that food tends to be very low margin and needs to be shipped around in vessels fueled by gasoline, I suspect that we'll see some pass through by next month as well. So what does the Fed do with it? Right now, I think that there's enough, kind of past experiences that we can rely on to suggest that the energy shock is something they should look through. They're going to be more cognizant about whether or not we see some damage on the ground in terms of the labor market. And if they do, I do think that they'll cut because if the labor market is falling apart, there's no way that these higher prices can be sustained outside of energy.
And I mean, there's a lot of pressure, obviously, for a cut from the White House. How much of a factor would that be, or will these numbers be will decide whether they can cut or not, depending on what we see, obviously?
Yeah, I think for the most part, it really does come down to the labor market data. Because as I said, I'm a firm believer that stagflation is something that can't really exist. So I wouldn't be terribly worried about cutting, maybe one or two times into high inflation if I knew that the unemployment rate was rising and likely to continue to rise. So I think that more or less dovetails with the administration's preferences for interest rates, which are, of course, quite well known at this point. I do think that there is alignment with, the incumbent Fed chair, Kevin Warsh. He is of same mind for the most part with the administration. So I do think that once he is in the seat, they are likely to adjust rates lower modestly, maybe one or two cuts in the second half of the year. But again, if things start to really change and the labor market starts to show, quite a bit more weakness, I doubt that they would hesitate to act there.
I just want to go back. You mentioned food inflation was unchanged or down. Was it down even? Did you say?
Technically, it was down 0.01%. So most people that are, most normal people that look at the data would say it was unchanged. Yeah.
And you were why do you think that came in the way it did?
It's a good question. I honestly didn't take too much attention to look at the component breakdown of which foods were up and down. But my suspicion is that it's just a kind of distributional thing because food prices were up a little bit more in February. I think they were up about 0.4%. So, again, one of those things where it sort of is misaligned with people's, experiences that they talk about. I don't think people really thought that food prices went up too much in January and February, but I suspect that it's just a measurement issue and something that's likely to reverse, as we go forward.
All right, and now with energy, I mean, there's a whole bunch of questions with this, really, isn't there? I mean, it depends what happens this weekend. It depends what happens next week. If prices are sustained, or even if they drop, a barrel drops to 90, what kind of an impact does that have?
I think that we're probably sort of locked in for a little bit more inflation in energy prices, at least for the next few months in the U.S., right? I think that gasoline is, the supply chain globally has been disrupted to the point where it's going to be in shortage broadly for quite some time. And even if the Strait of Hormuz is opened up tomorrow and we had, normal ship cargo volume going through there, we're basically 6 weeks short on deliveries through the refining supply chain. So those shortages are going to last, I think, at least through the summer and into the fall. By then, I think, more likely than not, conditions will normalize and we'll start to see some of that energy inflation come off. But, it really comes down to less about the crude oil prices at this point and more about the sort of news in terms of how much gas is actually being delivered to places it needs to go around the world. In order to get gasoline back down to, where the administration wants it to be, which I suspect is somewhere around, less than $3, we probably need to see oil in with like a 50 handle again. And I'm not sure that that's something we can realistically expect anytime soon.
Sorry, $50 a barrel?
Something like that, yeah. Because recall at the beginning of the year, gas was just barely below $3 on the national average. And I believe crude oil prices were like $58 a barrel, somewhere around there. So yeah, lower 60s, upper 50s, that's probably where you need to go in order to get gas down back to those levels that we saw at the end of last year, beginning January.
Yeah, because we've heard from a few people that saying that realistically it's not coming back down to those numbers. Maybe 70 is optimistic. How much of a long-term factor would that be then if oil stays up around there, around $70 a barrel? Would you be looking at $3.50 a gallon maybe down in the States at that point?
Yeah, and I think that's actually a tolerable level for most consumers. One thing I did when gasoline started to go up quite high was try to contextualize what the recent price increases look like relative to history, right? So if you just kind of inflation adjust gasoline with the CPI going back to 1990, we've had a few spikes. June of 2022 with the Russian invasion of Ukraine, the real value of gas was like $5.50 in 2026 dollars. Same levels prevailed in early 2010s when the economy was generally pretty sluggish. And in 2008, the real adjusted value of gasoline was like $6.50 a gallon. So if we're less than half of that, I think that that's a situation that most consumers can handle, especially because the labor market so far has held up and wage gains are still, relatively reasonable in the 3 to 3.5 range. I think that's something you can expect to continue. So I'm not concerned about an inflation-driven recession until we get gasoline prices substantially higher from here. And I would kind of sort of take them off the table of my risks if they went back down to that sort of 3 to 3.50 range.
All right, we got to wrap it up there, Thomas, but thanks very much for joining us.
Of course, thank you.
Thomas Simons is Chief U.S. Economist at Jefferies. Coming up, today's market drivers with Bloomberg's Monique Molima. Time to take a look at some of the market movers, and we're joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. Let's talk about Nexstar Media. It's getting an upgrade.
Yes, Nexstar Media, their shares are rising this morning after Citi upgraded the stock. The company is in the process of buying Tenga, which is another media company, but this acquisition has had a temporary restraining order put on it while some judges in the U.S. determine whether there might need to be some selling off of assets to divest in areas where there might be some concerns. But Citi actually says that the share sell-off that's been happening because of this restraining order might be a little more bearish than needed. They see a lot of upside opportunity if they are able to keep all of their assets from both companies. They say that could provide over $70 of share upside compared to $8 of downside if they have to divest some of those assets. So they really see a lot of opportunities ahead for the company once this combination goes through. And they think that maybe some of the sell-off has been overdone and that there will be some more opportunities for the company ahead.
All right, this is your chance now to maybe buy a hockey team or a basketball team. What do you say?
Yes. Yes, so Madison Square Garden, they have been looking to spin off some of their assets, including the Knicks team and the New York Rangers. And this is something the company has been considering for a while, but hasn't started the process of. But they got an upgrade today at Seaport after they said that they think that this might be moved forward. Currently, the company isn't getting the full value for these two sports teams in its shares right now because of some of the other assets that Madison Square Garden owns. But with some changes coming to tax requirements in the U.S., this could mean higher taxes for the company going into 2027. And they think that this might give the company kind of the push it needs to really move ahead quickly with spinning off these two sports teams, because they know that if they were to spin these off, it would mean a lower tax burden going into next year. So they're really positive on the opportunity for these two new potential stocks and the value that they would be able to get for them.
All right. What goes up must come down, and Occidental's learning that.
Yes. So Occidental, their shares are down this morning after the company gave its first quarter guidance for commodity price realizations. And the total worldwide oil prices that they realized on average for the quarter were lower than what analysts were expecting. They were around $69 a barrel. And that's part of why we're seeing the decline in shares today. Those were worse than expected when compared to WTI prices. But their natural gas prices were slightly better than expected due to the rise that happened in gas prices in the quarter. And then Occidental's also facing some of the pressures that are in broader energy markets today as people await to see what's going to come of the meeting between the U.S. and Iran this weekend.
All right, and last up, Southern Copper getting an upgrade, but also facing some challenges as well.
Yes, so Southern Copper has faced some challenges recently with the passing of their CEO and also some of the broader things that have been happening in copper markets. We saw copper stocks in particular face some pressure during the Iran war as lower expected demand and inflation fears weighed on the metal itself, which then in turn weighed on some of these miners. But we are seeing their shares rise today with some of the others in the copper space, again, on hopes that maybe this meeting between the U.S. and Iran this weekend can come to a resolution, can mean an end towards the war, and then we'll see some of those macro pressures kind of lift on the copper space more generally.
Okay, we will wrap it up there. Monique, have yourself a great weekend.
Thanks, you too.
Bloomberg's Monique Malema. Canadian employment rose by just over 14,000 jobs in March, coming in below expectations. We'll have more on that after the break. U.S. President Donald Trump says Iran is doing a very poor job of handling the Strait of Hormuz, saying it is not following the agreement in place. Iranian lawmakers say some ships going through the strait are being charged fees as high as $2 million. The comments come after this week's ceasefire talks between the two countries, and more discussions are scheduled for Saturday. Shares of MTY Food Group are under pressure today, down about 4%. The owner of Cold Stone Creamery and Mr. Sub posted revenue in its latest quarter that missed estimates, falling 6% compared to the year before. MTY also saw a decline in corporate store sales in the U.S. Now, on the upside, the company reported higher profit, with net income up sharply from a year ago. That jump was largely driven by foreign exchange gains. Shares of Chorus Entertainment are taking a hit after revenue in the latest quarter came in below estimates. It's off about 14.33%. The Toronto-based media company reporting a 15% drop in consolidated revenue, with its television business the biggest drag. However, Chorus did see its overall loss narrow from a year ago. The company's chief executive says it is making meaningful progress on key initiatives despite ongoing industry and macroeconomic pressures. Looking at the markets, the TSX rallying nicely today, up 0.75 of a point, well into 33,000, almost at 34,000 again, getting close to the record highs from earlier this year. U.S. markets, bit of a mix, but still up 2/3 of the way. How's that? S&P 500 up by about 0.18. Dow down 0.27, and the NASDAQ is up by 0.68%. According to Stats Canada, 14,000 jobs were added in March, a slight recovery from the 84,000 lost in February. We are joined now by Tony Stillo, the Director of Canadian Economics at Oxford Economics. And Tony, thanks very much for joining us.
Happy to be here.
14,000 jobs added. It's always good to see some jobs added. Is it going in the right direction? Was it enough compared to what we saw disappear over the 2 months prior?
Well, clearly didn't recoup the jobs we lost in the prior 2 months. It was 109,000 jobs according to Stats Canada. But it's steady. It is steady and a little calmer month than what we've seen earlier in the year. So it's a step in the right direction.
And the 14,000 we added, are they good jobs? How would you rate them?
Well, they were all part-time jobs. So a job's a job, but to have a bigger impact on the economy, of course, you want full-time employment. You see, we think we're still in a bit of a rough patch. This is actually a little better job performance in March than we had expected. And we think the months ahead might see some more modest job losses. We've got headwinds from the tariffs is still at play, the trade policy uncertainty, and now the conflict in Iran that's going to push up energy costs and squeeze households.
And is this businesses? I mean, we've been talking about the slow hire. Is this them finally having to speed up the fire a little bit?
We're not looking for major job losses. No, we think it's still a largely slow hire mode. Businesses have been really hesitant to make major decisions whether to hire or to fire or to invest in capital because of great uncertainty out there, elevated uncertainty from these two major events that are outside of our control.
And what's the bigger of the? I mean, they're both big, obviously. But what's the bigger one? Is it CUSMA? I mean, is that what everybody's waiting to see?
Well, we've been identifying that as a pivotal point in terms of how the economy will proceed moving forward for Canada. But let's face it, a global conflict that we're seeing in the Middle East now, that is equally pivotal. And so they're both really important to see an early resolution to the war so that there's a short-lived conflict and we'll see energy prices retreat. And we're hoping for a favorable outcome on the trade deal with the U.S.
All right, and going into the numbers a little bit, you said most of them were part-time. Were there any positives in there?
Well, yeah, the positives were that there were some.
There were some
but we had some jobs in office. Other services, which is personal services in repair. We had some professional scientific services increase. We had natural resources, which is mainly mining and extraction. See some positive job gains. And manufacturing was up a tick, like just a few thousand jobs, still suffering the most of the weight of the trade war. And so these are positive, but it was very much a modest changes across most sectors. Actually quite welcome after what we saw, which was quite a huge drop in the previous 2 months. So that alone is a positive. I'll take that one.
All right, we got to have some optimism for Friday heading into the weekend. I was looking at the average of the hourly wages. They were up 4.7%, but that was a little bit of accounting, wasn't it?
Oh, absolutely. If you control for the mix of employment, the increase in average wages was 3.6% year on year, which is the average we've seen in January and February. So really, it was just a compositional effect. So I wouldn't worry about that, making an issue for the Bank of Canada and what they might do.
And let's go to that. What do you think? Where does this leave the Bank of Canada?
Well, they've been in a pickle for a while because these are supply side events. The trade war and potentially big change in our trade relationship with the U.S. and the potentially higher inflation and weaker economy that comes from higher oil prices. So they're kind of in a bind, but they're ready to move in either direction. Their current rate is at 2.25%, the policy rate, and that's, in our estimation, modestly supportive of the economy. And we think they're going to stay on hold for the rest of the year, but be ready to move in either direction. If the economy turns south more so than expected, they'll cut. If there's concern about inflation, rising because of the oil shock and leading to higher energy costs that flow through to other goods and services, they'll be ready to hike. I think they're most likely to stand pat and hold for the rest of the year. And that's, probably all they can do with monetary policy. There's going to be other support from the fiscal side that's building in the economy. We've got major fiscal expansion, and that modestly stimulative monetary policy is already there that's helping to support. And I'll just identify one that's very timely. The recently introduced groceries and essentials benefit by the federal government is going to hit the pocketbooks and bank accounts for low and medium income households in the second quarter. Very timely, just when they need it with the higher energy prices from this Iran conflict.
And obviously affecting the Bank of Canada rate will be the CUSMA negotiations and oil. Now, if we do see, it looks like this piece is going to hold, the strait opens up, there's still talk that we could see oil at $80 a barrel. How much of a factor would that be for moving forward?
Well, it is. And the idea is even we at Oxford Economics expect this conflict to last a couple of more, let's say the rest of the April. Hopefully it ends then. But the Strait of Hormuz will probably not see normal traffic flows through to the end of the year. That's going to keep energy costs or global oil prices and other commodity prices high for a while. That's going to weigh on the economy, but we don't think enough to cause a recession unless it was a much more prolonged conflict and leading to much higher oil prices.
Okay, we have to wrap it up there, Tony, but thanks very much for joining us.
My pleasure.
Tony Stula is Director of Canadian Economics at Oxford Economics. Coming up, Canada's office market. Is it finally turning a corner? A new Colliers report shows national vacancy rates declining for the first time since the pandemic. We'll get more on that when we come back. Canada's office space market may be turning a corner. A new report from Colliers shows the national office vacancy rate, that's combining the two, fell by a full percentage point from a year ago, one of the biggest improvements since the pandemic. Fewer new buildings and more return to office mandates, along with rising demand for top-tier space, are all helping tighten the market. For more, we are now joined by Adam Jacobs, Head of Research at Colliers Canada. Adam, thanks very much for joining us.
Happy to be here. Lots to talk about. Happy to have some good news to discuss on the real estate side.
That's a huge jump, isn't it? Relatively speaking.
Sort of endless, the rise in office vacancy and the challenges we were having in the office market, but it couldn't last forever. We spent 5 years with sort of too much supply and not enough demand, and then we woke up in 2026 and found we had too much demand, and suddenly there isn't anything being built. The supply has really come down, and the market, it took a long time for this cycle to work itself through, but we're starting to see it correct itself and come back to a more normal market.
And what's the big driver on that? The biggest one, is it the people going back to work now, or is it what you haven't built? I mean, everything's been put on hold because there was no demand.
Depends a little on the market. I think in Toronto, the story really is return to office. A year ago, that didn't seem likely, and now we're here with every major tenant, from government to banks to tech, coming back to the office. I think in other parts of the country, that's less of a factor, but just the slowdown in construction, you see it everywhere, in the office market, in the housing market. We're at the tail end of that cycle. A lot of new office was built, and that's not going to be happening for the rest of the decade. So we're starting to see the downtown fill up a little bit, and the demand is really there. We see it from all the usual big tenants, government, tech, banking, insurance. All of those are coming back and leasing more space.
And let's look at and different cities, different locations. You mentioned Toronto. What kind of a change has it seen?
Change, and I think a really big change downtown. The downtown really suffered, I think, more so than the suburbs, with the elevated vacancy, with all the new buildings being added. And we're really seeing a much more rapid turnaround for the financial core, the immediate downtown. There's just huge demand there, and that's where the return to office initiatives are really centered. I think in the suburbs, it's been a little more moderated. You haven't seen quite the feast or famine over the last 5 years. But the story is really centered in downtown Toronto, new buildings, but just really strong leasing, really strong demand from, like I said, kind of the usual suspect tenants. Generally, downtown's usually a tighter, stronger market. That hasn't been the case for the last couple of years, but if you look historically, that's almost always true.
And similar situation in places like Montreal, Ottawa, Calgary, Vancouver?
I think we're seeing it in most of the major markets. Ottawa is always a bit of an outlier because it's just so dependent on what's the federal government doing. But yeah, generally we're seeing that vacancy come down. We're seeing construction really slow to almost zero in most cities. And you even see a few cities like Calgary where it goes the other way. We're converting office towers. We're making them into new uses. So that ends up shrinking the inventory and shrinking the vacancy.
And there is a danger with that. I want to talk about that, the lack of building. What about small markets? Do they kind of go like this a little more than the major markets did? I don't know if you can see my hand movements there. I started doing a little break dance for you.
Yeah, I like it. It's a little less predictable. Those are just smaller markets and maybe a little more influenced by one big relocation, one big new building. But most of the markets we look at, we're seeing the the vacancy come down for office. It's just different factors. I think there's also the differential of who's more or less impacted by the trade war and tariffs. Again, big impact in Ontario, maybe less of an impact in Saskatoon and Edmonton and some of the other markets we track.
And the companies, when they're coming back, are they coming back with the same number of people? Are they using the same amount of space, or are new companies coming in?
I think it depends. I think we often underestimate also how much larger the country and certain employers have gotten over the last 6 years. We had really big population growth, and what we're finding is your big employers are saying, we want to go back to 7 or 8 years ago, but they're actually much larger. They have more staff, they have more salespeople, they have more tech people, they have more everything. So even if there's hybrid, there's just been a general swelling of the workforce is larger, and now that's bumping up against a situation where new buildings aren't being built.
And so with that, with the new building, what kind of an impact could we in 5 years go, hey, we have a real shortage now?
I think it's possible, actually. It seems crazy to say that after what we've just gone through, but it's all of this real estate stuff is very cyclical. We see it in home building, we see it in retail, we see it in all the assets. And office was incredibly hot 7 or 8 years ago. Then it went, had the shock of a lifetime with remote work. But if you start to project it forward, there's almost no new construction. The rest of the decade, not much is going to get built. And if you think the population is going to keep growing, the economy is going to keep growing, there is going to hit a point where maybe demand exceeds supply again.
And then we'll be talking about the opposite concerns and issues with that. One of the things you mentioned, I remember when I worked in Vancouver about 20 years ago, they were talking about this as being an issue, that they converted to a lot of places. They were starting to convert to condos because people were commuting out of Vancouver into the suburbs, and then they didn't have office space. Is there any major city that you're seeing the most of that? I think you mentioned Calgary.
Yeah, Calgary is a unique case with the elevated vacancy, but also they really have a full city government initiative to kind of address some of the longtime vacant buildings, and there's a fair bit of money behind that to make that happen. I think in the other markets, there's a lot of talk about converting office, but everything we hear is it just doesn't make sense financially, given the cost of purchasing an office and re-engineering it for housing. I think it seems like a simple solution, but the practicalities of it are quite different. So aside from a few cases on the margins, I don't think you'll be seeing conversions of office, certainly not in the expensive markets, your Toronto, Vancouver office markets. That's a long way away from happening.
All right, we got to wrap it up there, Adam, but thanks very much for joining us.
Very happy to be here. Thanks for having me.
Adam Jacobs, head of research at Colliers Canada. Coming up, billions of dollars in sports media rights are in focus as the U.S. Justice Department has opened investigations into the NFL for potential anti-competitive practices. We'll break it down after this. The U.S. Justice Department has opened an investigation into the NFL for potential anti-competitive practices, shining a light on how the league controls distribution and media rights. With billions tied up in sports streaming and broadcast deals, what could this mean for broadcasters, streamers, and especially fans? Here to help break it down is John Orend, the sports correspondent at Puck. John, thanks very much for joining us.
Happy to be here, Roger.
It's complicated and convoluted a little bit, so try and break it down and explain what the issue is and what the Justice Department is looking for and what the NFL is trying to defend.
Well, the issue actually is a 60-year-old law, the Sports Broadcasting Act of 1961, which said that the NFL can basically run as a monopoly. And as they go into the market to sell their media rights, they can go as one big entity and force the broadcasters to pay a lot. What they gave up is that they have to put their games on broadcast television. And so, in the 1980s, Turner Sports down here and ESPN started carrying them. And that was, of course, pay cable. And it was pretty small and insignificant at the time. But the NFL made sure that all of the local games were on local broadcast television. Well, fast forward to now, and Netflix has a couple of Sunday games. Amazon has Thursday Night Football. YouTube carried a game, and the NFL has started to renegotiate deals with the TV networks. And as it's renegotiating the deals, some of its executives have said that if they're thinking about reach, maybe there's a better reach than broadcast TV. Maybe if you go to Netflix, you get a reach of the entire globe. And so they've been talking more about shifting more games to streaming, which is what every other sport has done pretty much. But as they're doing that, the Congress is taking a look at this and saying that it runs afoul of the Sports Broadcasting Act. And if the NFL continues to do that, perhaps we'll take away the antitrust measures. And if they take away the antitrust measures, who knows what's going to happen? It could really send the entire market into chaos, where you have potentially the Dallas Cowboys negotiating its own set of media rights, and then you have the Jacksonville Jaguars negotiating its own set of media rights. And so if they take away the antitrust exemption, you could have somebody as the commissioner of the NFC East, and somebody as a commissioner of the AFC East, and or somebody just selling the rights on their own, which is really kind of what we have in the States with the college football right now.
By
the way, I tried to boil that down. I hope I did a good job on that one. Are you more confused now, Roger?
I'll take A. I want A. So first of all, why has this been unchanged for 65 years? Like, the landscape is so evolved that the legislation, and I hate to say that it was 65 years ago, 1961. I feel horrible about that. How have they updated it at all through the years with all the changes that we've seen in media?
They haven't upgraded it at all. And one of the reasons, this is much more than just, Fox broadcast or NBC broadcast. This is really about the local stations. And one of the things that the chairman of the FCC, Brendan Carr, and several senators and congressmen, it's a bipartisan issue, actually, is they want to make sure that the local affiliate in, say, Tacoma, Washington, name your mid to small town or city in the States, remains viable, because those local broadcasters give out local news, they give out local weather reports, and they are a benefit to the community. And so they want to make sure that that they keep NFL programming and the ad sales that come from NFL programming. As for why it hasn't been changed, there's been no real need to change it, because the NFL, even now with Netflix and Amazon, I think the 87% of their games are on national broadcast television. Like, it's still a huge amount, more so than any other sports league in the States. The NFL is committed to broadcast television, and that is because of that 1961 rule.
So if we saw some of these changes, the NFL might lose, but the teams might win, right? Would that be? And then fans would lose, because they'd be having to pay left, right, and center in 18 more different locations.
The NFL, I don't know if the NFL would lose. The Dallas Cowboys would win. The Kansas City Chiefs would win. Name another popular team. The Chicago
Patriots,
Bears, maybe
the Bears. The Bears.
Exactly. You know who's going to lose? The Jacksonville Jaguars. Like, how much are those rights going to go for? The Tennessee Titans, maybe the Houston Texans, and so you're going to end up with a market of really of haves with the Cowboys and have-nots with the Jaguars, and then how can you maintain a competitive balance then? I mean, the one joke that we reporters always talk about with regards to the NFL is that you have 30 of the biggest capitalists owning the teams, and they operate in a very socialistic formula. That works very well for the NFL right now.
Socialism that involves 30 people. Okay, where do you see this ending up?
I hate to not answer your question, but it really is too early to tell. I've been asked this already a couple of times. This is either a really big deal or it's nothing. and there's nothing in the middle. And I can't quite figure out whether it's the Trump Justice Department doesn't have a great track record, but this is a bipartisan issue. Like people on all sides of the aisle are for keeping NFL games on broadcast. So it is so early, I can't handicap it, but it's going to be a big issue, certainly for the league and for the networks.
Is there one thing that might make it a big deal, and there's one thing that might make it a nothing burger?
If it's a nothing burger, it'll be an investigation that leads to no changes. If it's a big deal, they take away the antitrust exemption, and then the teams or the conferences or even the divisions, or maybe you get 2 or 3 teams go and negotiate on their own, and then that takes what is a pretty nice little media system right now and throws it into chaos.
And have you heard any of the owners? I imagine they're fairly tight-lipped, but has anyone said, "Hey, this is a good idea"?
Nobody thinks. None of the owners thinks it's a good idea. If it did happen, though, you better believe Jerry Jones would think that he would profit the most out of this. I would imagine with the Cowboys.
All right, we got to wrap it up there, John. But thank you very much for joining us and explaining that to us on a Friday. We appreciate it.
Thanks for having me on.
John Orand is a sports correspondent at Puck. Market Calls coming up next. Today on the show, we have Rick Rule, President and CEO of Rule Investment Media. He'll be taking questions on natural resource stocks. Thanks for watching Morning Markets. We'll see you on Monday.